Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
If you've been hearing more about 351 exchanges and still have questions, you're not alone. Eligibility rules, asset requirements, timelines, and tax loss treatment all matter, and understanding them upfront is critical. Alpha Architect has operated over 50 351 exchange launches, and they've seen firsthand where advisors need clarity most. That experience informs the education-first approach, including their 351 Education Center with short videos, visuals, and on-demand resources. On February 3rd, they're hosting a live educational webinar to walk through common FAQs, real-world use cases, and lessons learned from prior 351 exchanges, plus a look at upcoming fund launches designed to address complex portfolios. Register using the link in the show notes. Welcome back, everybody. Happy 2026. Our episode with these two guys was so popular last summer. They got invited back. I don't know how this quick, but we're going to do another fun radio show today. D.A. Wallach, Dan Rasmussen, welcome back to the show.
Thanks, Meb.
You guys came on and you marked a kind of inflection point. We spent about half the time last time talking about the opportunity and also the decimation in biotech. And then the other half the time, I feel like dunking on private equity. But since that time, last summer, July 4th, I think biotech stocks are up 50%. So kudos to you two. Well done. That was a great inflection point. But here we are now. And Dan wrote a paper. DA's got a company going public. Everything's roses. But I feel like we should start out with biotech. You guys got any thoughts before we hit Dan's paper?
No, I think Dan should take us through it. It's a great paper and brings a nice sort of outsider's perspective to the sector.
I don't want you to say that. I want you to kind of, poke holes in it.
You're missing, Meb, that I sent at every juncture of the way, I called DA or sent him this stuff. So he's already given me all this critical feedback and ideas, but hopefully he has some more reactions too.
And now it's perfect.
Awesome. Well, look, this is a pretty involved project. How long did this take you, man? And then kind of we'll just walk through the whole thing. But this didn't take a weekend in AI.
No, this was a little over a year of work, almost a year and a half of work. It resulted, we were looking at our equity model and where it makes mistakes, where errors come from. And we found that actually the majority of our mistakes, and certainly our biggest mistakes, were coming from biotech. So we dialed that in a little closer. And we found that our factor model, which predicted asset prices very well for everything that wasn't biotech, just went totally haywire. And everything that we thought worked in regular world just worked the opposite in biotech. And so we said, well, this is weird. Let's dig into this. And what we found was really cool, which is, that biotech is the most uncorrelated sector. It's the sector with the most dispersion internally. And it's a sector where traditional factor models just don't work at all, where value, for example, doesn't work at all. And so that really got me thinking, well, if it is really highly diversifying and unique and really high dispersion, it would be very time well spent to try to understand the sector. The problem is, of course, that it's a very sort of inscrutable sector. It seems, a lot of it's based on scientific research and knowing the science and acquisitions by big pharma. And so the challenge was to say, what can we as outsiders who know nothing about biotech, who know nothing about the science, how can we figure out how to trade this sector? How can we approach it? How can we diagnose what drives asset prices in the sector? So that was the genesis of the work. And this is the result of a pretty substantial investment of time and resources to try to figure that out.
Let's dig in. One of the things, there's a lot of interesting takes in this. One is biotech by number is the largest sector. Did I get that right in the stock market?
Yeah, in the U.S. And it's I think by count, it's like 25% of companies. Now, they're all really small. So it's a little bit like, private equity saying there are 12,000 private equity firms and only 3,000 public companies. So yes, there are a lot of them. The market caps are very small. So it's sort of a niche small cap sector.
You start talking about the first part is just like the return distribution. It's like the traditional power law of equities, which is already most companies are pretty meager returns to money losers. most underperform the index, but then you have this small percentage that drives all the returns. That's even more true in biotech, right?
Yeah, that's right. Most biotechs lose money. I think the caricatures that, biotech companies, especially, and we focused here, this paper is on unprofitable biotech. So it's, doesn't include Merck or something. But what you see in unprofitable biotech is that 70% of these companies, the public equities lose money. And it's one of the worst sectors in that regard in terms of having the highest percentage of money losing equities of any sector. But on the other hand, there are these massive lottery ticket positive outcomes when something does work. So exactly that distribution that you're talking about, Meb.
You had a stat where you were like, all right, for the ones that are at least 200 million over the past 30 years, of the 70% that lost money, which is incredible, 50% got acquired at negative returns, 10% delisted, 40% are still public. These kind of zombie biotechs, you call them, but like of the remaining third-ish that were successful, half were acquired and the other half are still public. Let's talk about the factors that matter. If you can't just slap a PE ratio on something with no PE, how do you think about it?
So first, there's the traditional factors, right, that we all know work in every other sector are value, quality, and momentum. But here, none of those, if you define them the way you define every one of those factors, the rest of the equity universe, none of them work. Value doesn't work, momentum doesn't work, quality doesn't work, in large part because these companies are all unprofitable. And so that creates its own problem. So I'll tackle them in order. I'll start with value. So you have to redefine value for biotech because, again, they're all money losing. And the way we did that is to say, well, first of all, most of these companies raise a lot of cash. So, their enterprise value, which is traditionally market cap plus cash, you want to exclude that cash because if you think about the value, right, the bigger the enterprise value, the more expensive a company is. Well, the more cash you have should not be held against you as a biotech, right? More cash is good because it's going to fund your science project for longer. So you want to exclude cash and just take market cap. And then you want to think about, well, what am I measuring that against? What is the value indicator? And what we found there is that the best thing to use is spending. Because these companies aren't generating generally any revenue, they're all just spending money. What you want to know is their market cap relative to spend. And so you can think about, for $200 million of market cap, I could get a company that spent $200 million doing science or $5 million doing science, which is more expensive and which is cheaper. Well, buying 200 million of scientific research for 200 million is cheaper than buying 5 million of scientific research for 200 million. So you can reframe value as market cap to spend, and you actually get a very clear linear relationship between value and returns that works. It's just totally disconnected from how you'd think about value in any other sector. So that's the value part.
Right, which is probably why it causes things to go haywire. It's like kind of like the flip of what you would expect the rest of the world to look like.
Exactly. There's no other sector where that would make any sense except biotech. The next is quality. And actually, I credit DA for this idea, which is relatively brilliant. But DA, when I got started on this, he said, you've got to look at what the top biotech funds hold, right? That's a really important driver because they're doing a lot of this scientific research. And often a lot of those funds are crossover funds that, funded at the venture level and then took the companies public. And so that got me noodling on how do you sort of make sense of that idea, or how do you turn that into a quality metric or a signal? And there are some good papers on this, but essentially what we got to is let's look at specialist holders. So there's a lot of specialized biotech funds. And if you look at what percent of every biotech company is owned by specialists versus non-specialists, or what percent of the holders of each company are specialists versus non-specialists, in my view, that's a good definition of quality, right? If all the smart people that have their own in-house scientific research staff like a company, that's probably a good quality business. And on the other hand, if none of them like it, it's probably a low quality from a scientific perspective.
What's interesting about that, as I think about it, when you think about signals, not necessarily just the good and the bad, when you think about the specialists, in my mind, in particular in biotech, but in any very specialized high-level industry, it's not just about finding the winners, which sometimes it's a coin flip. Like you don't know how these clinical trials are going to go. Some of them are just major science projects. But a lot of time it's just like, you know what? This third over here are frauds. Like they've done this like 5 times. They're located in Utah or British Columbia, wherever. Like we know, just avoid these. And that's like a heavy lift. I feel like that's not trivial. amount that probably adds to what you're talking about here in the signal. It's not just finding the winners, but avoiding the kind of clowns too.
Right, exactly. And if no biotech specialist fund owns a name, it's a really bad signal, right? Like you couldn't convince anyone smart who deploys money in public markets to buy this thing, right? So it's only basically marketed to non-biotech people. It's almost certainly a bad idea. And you combine that with the value metric, right? And you can sort of do a sort of 3x3 of expensive, fair, cheap, low, medium, high specialist ownership. And you get this really nice spread of returns where you start to see things that those sort of fraudulent things, right? The fraudulent company isn't going to spend all that much money, right? They're going to have low spend because they're not actually doing science. They're ripping people off, and very high market cap relative to that, and no specialist ownership. Whereas conversely, you'll have, that really promising next-gen therapeutic, which spent $500 million doing research last year and has 10 specialists on the cap table, right? That is just a very different bet. And so I think those are the two ways that initially and quite simply spread returns within the biotech universe.
How do you find the specialists? I assume most of these are kind of private funds, not mutual funds. I mean, just call up DA and be like, yo, name 10 of your favorite hedge fund managers. Like, is that as easy as that, or is it more algorithmic?
We did that, but then since DA is too knowledgeable, so that creates a foresight bias. So what we did is instead, we want to make it objective. And so we said, let's define it as any public holder that owns more than $100 million of biotech and for whom biotech is 50% or more of what they own. And that usually gives you about 15 to 20 firms at any given time. But then that means it's always defined as anyone who is, right? Because otherwise, if you define it as some list, you're going to exclude all the terrible biotech funds that went out of business 10 years ago, right? And you want those in there because you're trying to use the signal today. You don't know ex ante which of them are going to work or not.
That helps guide a little insight. What else?
So then there's momentum. And this is the one where I'd say our work is most complex. But what we found is that, traditional momentum doesn't work overly well in biotech. So what we started doing, and this is influenced, but there's a lot of quant research out there over the last 10 years. And I know that this is a quite powerful signal, but a hard one to build, is this idea of sort of indirect effects or peer momentum, right? And you can think in other sectors, think about like suppliers, customers, competitors, right? Your own stock's momentum is informative, but you might also want to know how your customer stocks are doing, or how your supplier stocks are doing, or how your competitors are doing, that you could kind of create a mosaic of interconnected firms that would give you some sort of peer momentum or indirect effect momentum. And this is sort of a popular hot idea in quant that seems to be working. So we said, well, how can we apply that to biotech? And so what we did is we married a clinicaltrials.gov database to the equity database, which was a heck of a lot of work, and then classified all the clinical trials using the mesh tree. So we could say what type of research they were each pursuing, and then basically created a similarity algorithm to say, okay, how similar are different points in the mesh tree? And because it's a tree, there's a sort of a logical way to do that. And then said, okay, for each company, based on their trials they're working on, can we kind of come up with a similarity score for every other biotech? And then can we essentially multiply that similarity score by momentum and say, okay, what is the momentum of similar companies, right? So I'm an oncology drug. How are other oncology drugs doing, right? Companies that have oncology IP doing in the market right now. And we found that peer momentum actually works a lot better than using direct momentum, which I think makes some intuitive sense, right? If you hear that some company in a specific space has been acquired by Pfizer, all the other companies in that space might quickly get bid up in anticipation that they're onto something. So those are sort of the three legs of the stool in terms of value, quality, momentum. And those, I think, work quite well in sort of pricing, doing basic asset pricing within biotech. Of course, there are lots of further directions to go. I'd say, on my sort of research agenda, the two things that I'm working on now, one is profitable biotechs, which are their own universe, probably a lot more similar to normal companies because they actually make money. And then second is international biotech. And I'm particularly interested in what the hell is going on in China, because everybody seems to be talking about Chinese biotech. And I don't exactly know why, because I don't know. I'm not an expert in biotech, but trying to figure out what the hell is going on in China seems like another good direction for future research.
I want to get to China in a minute, but let's stick here real quick, because you also talk about, which I thought, as a minefield, is, some equity curves and we'll put this in the show notes, listeners, link to the paper, but shorting too. And I think about, oh man, shorting biotech and get one of these face rippers that goes up 5-10 times. But it turned out this multi-factor model looked pretty good, right?
Yeah, because again, 70% of these biotech companies are going to lose money in the stock market. And so there's sort of a gold mine for shorting here. The challenge, as with all shorting, right, but particularly in biotech, given the big right tail, is, you got to have a good model and you got to be good on sizing, because, you want to size these really small and you want to own a basket of them. But broadly, owning a basket of things, shorting a basket of things that no specialists own, that have a huge market cap relative to spend, and especially where, peer type firms are not doing well, right? That basket of things is pretty horrible, and it should be uniquely horrible relative to other small cap sectors because it's biotech and they're all losing money. And so they should sort of be disasters. The challenge, I learned this early in my career about shorting, right, is that sometimes, an obvious fraud or these kind of obvious disaster companies, you have to sort of think sort of that second level analysis and think, well, if it's such an obvious fraud, but now it has 400 million in market cap, it's an obvious fraud where the CEO of this thing is amazing at deceiving people and has found a ready set of people to deceive. And you shouldn't discount his ability to do that again at a larger scale and issue some press release about how, they've had some breakthrough discovery that sends the stock tripling. So you've got to be on guard against all those normal things, and probably, even more so in biotech, because as a place for fraud, telling people you're trying to cure cancer pulls on the heartstrings. And so you do see a lot of, fraudulent behavior in biotech.
Yeah. When I used to go to the FDA meetings in Maryland, back when I was a young pup in my 20s, you could almost always tell if a company was trying to get a drug approved that really had kind of crappy results, because they would bring up a bunch of patient advocates.
Oh, yeah.
And it was heartbreaking too, because, even just by the randomness, maybe one, got better or healthier and, that saved their life. And usually the results drove it. One more comment, and then we can maybe move on, or DA can chime in. But you also had a chart, and this, speaks to my heart because I love contrarian and big fat drawdowns and things everyone else hates. But we spent half the episode talking about this last summer. But you have a chart that ends in end of 25, so still maybe room to run. But it was the drawdown of biotech relative to the S&P, and you pick up 5 episodes where it was 60, 70, 100% type of underperformance. What's that tell for the future, if anything?
well, Meb, I've read enough of your work to know that it tells me something, the same thing that it tells you. It's just when you have one of these massive relative drawdowns, you should get interested, because generally a wipeout in the sector causes a lot of good stuff, babies to get washed out with the bathwater, and the recoveries tend to be really positive after these big drawdowns, really positive. And so, when we were talking in the summer, biotech was still in the middle of this massive, massive drawdown. And I remember, talking to an allocator who said, I was interested in biotech, who said, I got a call from some biotech fund that had been closed to new investors for 15 years saying, oh my God, we're taking money now. And, you either think, wow, like either this is the end of the world for the sector, or this is an unbelievable opportunity because so many people have kind of been purged from it as a result of the pain that's been felt over the last 3 years.
Is there a way to invest in this? You got a fund? Do I know that? Do I not know that?
We don't have a fund today, but we're pretty excited about this opportunity. So we're trying to find a way to implement it within our existing strategies and hopefully create something new as well.
Yeah, you can take my idea for you and DA to do a crossover fund from last summer. That thing would be up 50% right now, guys. Shame on you.
You should have. The problem is that both DA and I do too much research. If we were both a little bit more gunslingers, we'd just say, I got a good idea. Let's fire it up right now. And we'd be a lot richer right now.
Well, we got plenty of listeners that'll fund that part. DA, you mentioned China. Let's spend some time there. I don't think anyone listening, when they think of biotech, really thinks of China, or if they do, they probably think they're, in their heads, they're cloning babies and, doing all sorts of weird stuff. But talk to us about the opportunity. I was pretty surprised when you mentioned this, and I did a little research on just actually how big of a market outside the US biotech is.
Well, there are a few things happening all at the same time. I'd say the big picture that circumscribes it all is that the Chinese government decided several years ago that biotech was going to be a focus area for them for decades to come. And so they've put their money where their mouth was and have invested significantly over the past several years in investing in their internal infrastructure to do basic biotech research and then to do product development in the clinical setting. And so what we've now found in 2025 and going into 26 is that that investment has paid off. And it's principally manifesting in the market in two ways. The first is that big pharma, whose lifeblood is buying molecules that were discovered by small companies today, big pharma is increasingly buying their new early stage assets out of China. And so, go back 5-6 years, the percentage of big pharma's acquisitions that were coming from China were single digits. And I think in 25, it was between 30 and 40% of their acquisitions. So this is a sea change in big pharma's sourcing strategy. And, they have oriented more towards these Chinese molecules, mainly because they can get them much cheaper than they can buying comparable molecules from companies in the US or Europe. The other big thing that has changed, and it relates to the first, is that it's become much, much cheaper to do early stage clinical drug development work, meaning the first human trial that you do, or even the second human trial that you do in China, than it is to do that work outside of China. And so not only is that benefiting companies that have discovered their molecules in China, what's recently happened is now companies in the US and Europe are taking the products they've discovered in the US or Europe and doing their early clinical work in China because they can move much faster and they can do that work much less expensively. So this is an interesting, massive development for the industry. I've got a friend who's a US biotech investor as well, and he analogizes this to what the Chinese have done in the rare earth space, which was basically to start in a kind of marginal part of the value chain. In this case, it is early stage, first in human clinical trials, and use that as a toehold to start to build the capabilities to eventually eat more and more of that value chain. And, if you sort of play that out, the obvious goal might be for China to have its own homegrown large pharmaceutical companies that emerge over the next decade or two. And they would get there by basically progressively doing more and more of the early stage discovery and the later stage development that historically has not been done in China. I'd say the other tailwind to this is that there was a lot of skepticism around the quality of the data that was coming out of China because people perceived it to be, sort of undependable. Maybe there's a lot of fraud, maybe they're not as stringent as we are around patient consent and things like that are, ethically important in the industry. Some of that may be true, but I think what has turned out to be surprising to people is that data that was generated around certain drugs in China was then replicated in larger studies outside of China. And the industry saw that and thought, wow, actually, these products are better than we might have assumed they were. Now, no one's just taking that on faith. All the large pharmaceutical companies that are sourcing out of China have been building very large teams there. And that's partly because they're doing really, intense diligence on this stuff to make sure that it is in fact trustworthy. But you can clearly see this sort of shift in energy towards China. And I'd say a big question for the US government is going to be, how do we want to play that? How do we feel about it? Do we relax our regulatory approach such that we become in some ways competitive with them in these areas where their advantage has been, a more lax regulatory landscape, for example? And then, there are other things that are just going to be harder to compete with long term, but those transcend biotech. I mean, they have to do with the intelligence and industriousness of the Chinese people. And it doesn't help matters that we are educating a lot of their scientists. So for the past decade, doing what I do, I've spent a lot of time in US universities, and not to overgeneralize, but most of the time you go into a molecular biology department at Caltech or UCLA or something, and 50, 60, 70% of the postgraduate students are Chinese. And a lot of them stay here and, have come to the US because they want the opportunities that are here. But, I can think of anecdotes where there have been some phenomenal Chinese-born scientists educated in the US who start working at a biotech company here and then conclude after a couple of years, wow, these Americans are really slow. And they end up going back to China because the opportunity is so great and they feel that they'll be able to be so productive there as an entrepreneur. So, that's a pervasive challenge across technology sectors that is now becoming manifest in biotech.
And is most, you spend most of your time in sort of the VC early stage private world. Are you, when you take your lens there, is it mostly public companies or is it mostly private or university? Is it a whole mix of both?
Oh, it's both. They're doing everything. And so, there's a lot of access to capital there. There are good Chinese venture funds. And now there are lots of US venture investors who will invest in Chinese companies because they're great companies. And you also, as a US based or Europe based investor, run a new risk, which is that if you were considering a company in the US with a brand new molecule that they've filed a patent on, it's quite likely that 3 months from now, there's going to be a Chinese company that based on that filing will replicate their molecule or do something very similar to it. But then being based in China will be able to move much faster and supersede your US company. So US investors are having to consider whether or not they should basically be prioritizing Chinese companies that are able to move faster.
I don't know how indicative this is of anything, so maybe you can comment on it because you've seen a bunch of companies file to go IPO in biotech world in China and much fewer in the US. Although you have $1 billion to 1 that's now a public company. Is the IPO window opening? What do you think? What do you see on from that side of the bench?
Yeah, I mean, look, that's certainly the consensus view in the industry, but we all want that to be true. So you have to take it with a grain of salt. Certainly, the bankers are all lined up to take companies out in the first half of this year, and everyone's kind of on pins and needles waiting to see how that is received. I would say, the example of our company, $1 billion to 1, that IPO'd at the end of 25 was a good indicator because there was a lot of demand for it, both from the generalists and from the hedge funds. And then the rebound in the public biotech market that we saw in the back half of 25, I'd say most people believe that that is really owed to generalist hedge funds or public equity investors coming back into the sector, so-called sector rotation into biotech. And what drove that is not entirely clear. And I think that's one of the reasons, notwithstanding some of the great data Dan was taking us through, you have to be skeptical of these patterns, that like, after a big drawdown, you're going to have a great 10 years. I mean, it depends what drove the initial rebound here. And some of that may have just been that the AI trade was kind of played out among public investors. And so they had to then look at biotech once again as a place where they could potentially generate above market returns. The other thing to consider is with IPOs, we're going to, in my friend Tim Opler's words, going to be adding companies to the pool, which, in some way could be a headwind on returns of the broader sector. Now, the flip side is a lot of companies have been taken out of the pool over the past few years, as they struggled financially and ultimately had to shutter. So it's going to be a very interesting year. If biotech continues to perform, which we hope it will, that'll reflect that the starting valuations going into the year were still relatively low. But again, even going back to Dan's value factor there, what does cheap mean in biotech? Cheap relative to what? And I guess you can say, maybe spending is a good indicator of intrinsic value, but it's not a perfect indicator. I mean, it's not as good as a DCF on a traditional cash flowing business where you go, yeah, I mean, this is pretty much what it is worth if you were looking at it objectively, and then we can gauge the market's price against that. In biotech, it is intrinsically just a much harder space to value things on solid ground.
Maybe the spending is the CEO just YOLOing into the chance of trying to put all the chips on red at the roulette wheel or something. You never know. It's funny, you got poly markets in just about everything. There's a poly market now in IPOs. So what's going to IPO this year? And Discord's almost guaranteed. I don't see a whole lot of biotech on here. I see your DA was an early investor in SpaceX. You can tell Elon that we have the space ticker, SPAC. He can have that one. It's better than SPCX, I think. But if I look at this list, it's almost all tech. I don't see hardly any healthcare and biotech on here. So maybe that's just poly market. Who knows?
Yeah, I mean, I think folks are waiting to file in a lot of cases, but the general milieu is that everyone thinks we're going to have a bunch of IPOs. So we'll see what happens.
What else is going on in your world of VC? Has this 6-month ramp in biotech stocks, has that been an increased interest in your world? Has their funding picked up as well as deal making or investor interest, or is it still kind of coming off the bottom?
Yeah, look, there's certainly more optimism than there was. I think a big part of this comes back to the cash flows of those types of specialist investors we were talking about earlier, which is 25 was a great year for M&A. It was one of the highest years in history for biotech M&A. And so the proceeds of those acquisitions get recycled back through the specialist funds. And, what we're sort of waiting on, hoping for, is that a lot of companies that have been trapped in the private market now through this downturn can finally get out this year. Once they can get out this year, that means late-stage private investors are finally taking these things off their books that they've been carrying for a long time. And to the extent that they recycle proceeds back, they'll have the ability to reinvest in early companies. And then that conveyor belt that we talked about in our last episode can kick back into gear. So everyone's waiting on that. I'd say zooming out from just biotech, as a observer of the markets, what I've been really fixated on, I think, is just how divided the investment commentator market seems to be as to whether or not equities broadly are really expensive right now or not anything to write home about. And I shared a couple of things before the episode. We can look at a couple of charts that I think Goldman had put together. That there are two in particular that really tell this story. One is slide 2, which is the Schiller Cape since World War II. And when you look at this, there's sort of two observations you could make. One is, you look at where we are right now and go, whoa, that's really high. Scary, might foretell dismal long-term returns. The second thing you could look at this and conclude is that it might be a little arbitrary, but the horizontal lines that they drew here are meant to kind of depict some sort of regime change and some, lowering of the equity risk premium maybe over time, or a move towards just higher multiples for the foreseeable future. Then the other one that tells a very different story, and this is what Aswath Damodaran calculates as the implied equity risk premium. So he goes back, here to 1960 roughly, and the number in each of these years is derived from this sort of reverse DCF that he does on the whole market, where he says, in that year, what are the earnings that the market is estimating, based on consensus forecasts? And then let's assume we get those earnings in the years ahead. What discount rate do you need in order to arrive at the current value of the market? And that would be the implied equity risk premium when you subtract out the risk-free rate from that. And by this measure, it looks like we're sort of middle of the pack, right? So these are just two different valuation methodologies. And of course, no valuation is perfect, particularly when they're so general and you're looking at the whole market. But I was really curious to get your guys' take on these two lenses, and what investors should draw from thinking about value today in these two different ways.
I have a couple of thoughts. I actually just read a paper this past week. We'll put in the show notes. We'll probably get the authors on the pod, where they actually deconstructed the CAPE ratio instead of it being the broad market into current constituents, which I thought was pretty cool, or constituents at the time. So it's more of a bottom up, type of analysis than top down. My thing has always been to just kind of look at all the various, we track 10-year PE, 10-year cyclically adjusted for dividends, for book, for cash flow, for what's the other one? And there's another one. And they all generally tend to rhyme. There was a chart we put on Twitter years ago where it was a unmarked chart. So it just had two lines that were near identical. And I was like, anyone guess this gets, I don't know, free beer, free hat or something. And it was, I think, equity sentiment and a CAPE ratio, but it also shows, it's basically the same chart of percentage of people that own equities. It's the same chart of like 5 things, which the chart is just price, generally speaking. And so, how much of what we're analyzing is just simply something that's been a 10-bagger, or in the case of the Qs, a 20-bagger since 2009. And then in other countries, things that have gone down 60, 80, 90%. And I feel like when you're talking about valuation, and particularly long time horizons, that they seem to all kind of rhyme in my mind. But we like talking about the CAPE ratio because it's the one that I feel like people gravitate towards. Half of me is cheering that we take out the 99 highs of mid 40s in the US. As we're recording this, around 41, and the dividend yield is almost taking out the all-time low dividend yield of 1.1%, which is pretty incredible. Because I actually love looking at, there's a bunch of dividend funds out there with dividend in their name. And then you look at the dividend in the US and it's 1%, which I think is just like, I'm like, at some point you got to take out dividend out of your name. And obviously some of that's transformed. And this is kind of a big nerd alert. We're getting deeper, obviously the buybacks, but what that mostly transforms is the dividend growth metric. So the dividend growth is going to be higher despite the fact dividends are lower. But anyway, the one stat that we had is when we did our old research study on the CAPE ratio and other things. And one, by the way, we found that you could actually substitute any of the other CAPD, what we called it, which is just dividends, for CAPE ratio. It made no difference when you're sorting the countries by valuation metrics, which is interesting. But, when a country ends the year at 40, historically the future returns have been pretty low, near zero real. But we couldn't find one instance where it ended the year above 40 and the future 10-year returns were above average. And I think we used a pretty high bogey, but it was the US real return of 6%. So when we do this in 2036, we can check and see if that was a good prognostication or not. Dan, you want to chime in?
Yeah, I think you've done so much more work on this than I have, but I think the challenge here, and the reason that it's a topic for such debate, is that the CAPE ratio has been fairly high for a while, and that valuations have been fairly high for a while, and yet the U.S. has kept defying gravity in some sense. And I think I attribute that to a unique in history innovation wave that I think what's being produced in the US and sort of the technological revolutions we've seen over the past 15 years have actually been real and big and important and world changing, whether that's cloud computing or AI. And so there's been some level of which those valuations have been deserved, have been earned. These companies have actually grown into them. And so now we're left saying, well, we're paying these really big multiples, but these companies, if you thought they were done and then they pulled AI out of the hat, you're like, do you want to be betting against these people, right? Like maybe the only misstep any of these companies have made in the past decade is the metaverse, right? But everything else has sort of worked. And so you're left sort of saying, do I want to bet against US big tech and against US tech innovation? And I think a lot of people just feel like, maybe not, maybe the track record there is just so good. But then conversely, to your point, equity sentiment is, we're about predicting the future and how the future will be different than the past. And when we've had such amazing growth and then everybody's agreeing that that's going to continue sort of inevitably into the future is when we're most primed to be too optimistic. And so then I say, well, if you look internationally, which is sort of interesting, all the sort of old school stuff has worked, right? If you're sort of logical and reasonable, and if you if you just said, hey, let's do my old school value investing stuff, but exclude the U.S. from the analysis, it's all worked, right? Like the cheaper companies have done better, cheaper countries have done better, CAPE ratio has been predictive, and so you really have a world that's sort of working normally outside of the U.S., and then you have sort of this crazy tech innovation wave happening in the U.S. So I think my sort of a bifurcated paradigm has been, if you're investing abroad, follow the old rule book because it's working. And, if you're investing in the US, maybe just give up and own the index because gosh darn, are these companies doing well and has it been hard?
Well, it's funny, the stat we like to just put in people's brains, because I feel like people won't believe it when they hear it. But if you say like a global deep value approach has now beaten the S&P over the last 1, 3, 5 years, people assume that it's just because U.S. stocks consistently just keep doing 15% all-time highs, Dow 50,000. I was kind of hoping it was going to happen today while we were recording, but I imagine by the time we publish, it's going to have happened. But it's funny, Charlie Biello put out a good chart on Twitter where he looked at S&P versus equal weight since the 70s. And, it's a story of runs. Like, people, you go to the roulette table, everyone assumes it's going to go red, black. And then if you know anything about math, you get these long runs. And I'm eyeballing this chart, and you had periods, obviously, of 8 of the last 11 years, market cap has beaten equal weight. But then you had a run in the early 2000s, 7 years in a row where equal weight beat the S&P, and then another period in 2009 post where it was 5 of 6 years, and you again go back to the 70s and it was 6 years in a row and flip. It's kind of a story of runs, which really all comes down to is just bull market, kind of bear market often too. Like, is the market cap just stomping everything? And who knows if it's going to happen again next year or this year or not. But it's just interesting to see that you're both looking at U.S. stocks and yet you can have these dispersions of 10, 20 percentage points in a year, which is kind of nutty if you think about it, just on the same stocks, just weighted different.
Totally. I'd maybe offer a rejoinder to Dan's theory about technology, which you would expect to show up in measures of productivity. And now people critique those measures. Maybe they're not perfect. Maybe the hedonic adjustments and so forth that play into them are not comprehensive. But I sort of side a little bit with the Peter Thiel argument that we were promised all of this amazing innovation. We got some really great innovation, but how big an impact did it actually have on our economy in measurable ways? So, productivity growth roughly been 1.5%, just chugging along for a very long time. And it doesn't seem like many things that we come up with really push that very much. So, an interesting way of looking at the AI question even is, you could start by saying, do I think this is going to be smaller, as big, or bigger than the internet in terms of just, how important, how impactful a technology is? And if you thought, okay, I think it's going to be base case, let's say it's as big as the internet. Well, then you can go back and see, well, what did the internet do to the economy? And what it did was it pushed productivity growth from 1.5 up to 3% for 6 or 7 years, and then it went back down. And it's like, that is a seismic event in human technology history, but it's pretty amazing that it has such a de minimis effect ultimately on the wealth of civilization. And so I would sort of come back at Dan and say, well, look, my view is maybe it actually hasn't been technology. Maybe something else structurally has been going on. And I would point to slide 19, which shows real profit levels. And, what if what has been happening in the corporate economy that has powered equity performance over the past decade is just something that keeps going? That's not to say like the investor enthusiasm is going to continue on some kind of baseless momentum basis, But, what if we are actually in the midst of very long-term global processes relating to the allocation of wealth in our society? And, I think what you see here is pretty striking. On a real basis, just since COVID, we had profits go from roughly 11 cents on the dollar up to 14 cents on the dollar. I mean, that's insane. That's after inflation. If you don't adjust it for inflation, it went from 11 cents to 18 cents. So what's clearly happened is owning businesses has become much better than it used to be. And the profitability of businesses has become much higher than it used to be. I think there's this great paper that Chris Brightman put out, and I took a couple of charts from it that we could look at here. I think, the most helpful one is on slide 17. And this just shows the trends for the past several decades in some kind of the major variables in the economy. And what you can see is corporate profits, align with that chart I just showed. Corporate profits have gone way up. And the question is, well, what's driven that? Chris Brightman's explanation is it's deficits. Deficits drove it. Basically, the US government borrows money. It sends that money out in entitlements to folks who have a very high propensity to spend because they're not wealthy enough to save. And where do they spend that money? They spend it on the products and services of American corporations. And what could have happened with those increased revenues is that corporations could have invested more in growing their productive capacity, but they didn't. They did the opposite. They invested less, and they distributed those profits in dividends and buybacks to their shareholders. Their shareholders are basically the rich who have a low propensity to spend, who recycled that money right back into equity markets. And so the final piece of this, just to end this kind of conspiratorial macro rant, is there's an amazing report that McKinsey put out in 2020. And I want to just show two charts from it. This is about the global balance sheet. So let's first look at slide 20. And I just thought this was so interesting because this is basically like the global economy in one slide. And what you see here is that ultimately, most wealth is held by households at the end of all of it. And real assets basically equate to the net worth of households. Financial assets are effectively a way of moving around that net worth in a very dynamic and liquid way in global markets. And what you can see here, the story of this report they wrote is that the global balance sheet has increased by like a factor of 5, I think, over the past 60 years. And this decomposes what has driven the growth in that net worth. And if you look at the United States here, what you see is this decomposition where on the positive side, some of that growth has come from investment by corporations, but the vast majority of that growth in net worth has come from price increases. Big component of that is inflation, but the other big component of it effectively is multiple expansion of all global asset prices. And so we can go, well, why did that happen exactly? I think part of it is this profitability story. Businesses actually became better to own over a long period of time. And you can ask whether that's going to continue. Another source of that would be this deficit issue that Chris Brightman elucidates. Are deficits going to get bigger or smaller? They might get bigger. That could continue. Businesses could become more profitable if the deficits keep going up. And then you also have much greater and broader participation in equity markets. So it sort of stands to reason that if more people are investing in equities, there's more demand for equities globally, corporations have to give people a lower return to attract them. And therefore, you should expect lower returns or a higher CAPE or a lower ERP, however you want to frame it. So just food for thought, what I've been obsessed with here is like, is it possible that we're in the midst of a very long and global process? And we're in these day-to-day conversations about valuation and cycles. Are we mistaking what we're experiencing for shorter term cyclical types of behavior.
Just for my sake, because I'm a big Japan guy. What do you make of how weird Japan is on that? I mean, like you say, global. It's global X Japan. Japan's just a total anomaly on this.
I mean, the only thing I can read into Japan is that economists don't understand this interplay between investment, deficits, inflation. I mean, everyone has their theories, but Japan defies those theories. And, they're running a deficit that's 200% of GDP. So we're here debating whether the US at whatever it is, 106%, I'm probably wrong, but we're over 100% now. Whether that is sustainable, whether it's going to cause a debt crisis. Well, Japan's been there for a long time. They haven't had a debt crisis. People will point out what you should look at is the sort of net position of the government, and they own a lot of financial assets. They own a lot of domestic equities, and they own a lot of domestic sovereign debt. So that changes that picture a little bit. But, for a long time, the secular stagnation hypothesis that Larry Summers was the most vocal exponent of basically warned against Japanification of the other industrialized economies. And I think his argument was basically the prospective returns on corporate investment are so low that you are incentivizing these economies to invest too little and to have savings gluts. And, to your point about investment, like we really need faster productivity growth. The way we get that is by having higher returns on investment for corporations. And technology is all that can really raise the rates of return on that investment above the cost of capital. If we don't have a spread of ROI over cost of capital, companies just won't invest as much as we'd like them to, and net investment will continue to go down.
I'm doing my annual ski trip to Japan in 2 weeks, so I just need the yen to hang out above 160. Dan, I know you got a lot of activist campaigns over there. I'm guessing there's not going to be so many in Hokkaido, but if you got any companies you want me to drop in on when I'm up there, I'm not going to be spending any time in Tokyo, sadly, but up in the northern Sapporo region, let me know. But Japan had a monster year last year. Is this going to continue? What do you think?
I'm really excited about what's going on in Japan. I mean, these corporate governance reforms are having just a huge positive impact on payouts, on dividends, and on buybacks. And if you look at how much room Japan has left to go on that, it's relatively massive. I think if you look on a sort of what percent of EBITDA is getting paid out in the form of dividends and buybacks, Japan's at sort of like half where the US is. So, they've got a long ways to go on that for the median Japanese company. And then even more striking is that during those lost decades, Japanese companies were saving a lot. Japanese companies were saving a lot. They weren't doing distributions and buyback. They were just putting assets in their balance sheet. So if you look at the median company in the US has about 1 year worth of net income in assets, whereas the median Japanese company has about 7 years of net income over assets. And if you go down into the small cap value world, it's not hard to find companies with 20 years of net income in assets. So these are really, really asset-rich companies that are not really paying out much in dividends and buybacks. And so they have sort of two levers to pull. One is that they can start taking down those assets and just saying, hey, we're going to distribute these assets in the form of buybacks and dividends. And they could do years and years of dividends and buybacks, years of net income just distributed off balance sheet assets. And they're paying out very low payout ratios of what they're earning on an ongoing basis. Now we're also finally seeing some level of inflation, which in my view is a sign that nominal GDP growth is returning. And so now you're getting growth, you're getting distributions, and you're getting these corporate governance reforms start pressuring them to take those assets off the balance sheets and return them to shareholders. I think this has got a long way to run. And I think you're also seeing it, in terms of flows. I think, so many people had no allocation to Japan. They weren't interested. It was too niche, even though it's the third largest market in the world. And now finally, you're seeing renewed attention to Japan, where people say, oh, maybe I should fly over to Tokyo and see what the hell's going on over there. Maybe I need some allocation. Maybe I should be market weight, and then trying to figure out how that market works. So I think it's a really exciting time in Japan.
And Dan, when you're talking to some of these companies, I mean, I know you guys write letters to some of these management teams and stuff, which is really cool. What do you hear back? Like, how do these managers justify sitting on such ridiculous balance sheets? And then, I'd also love to get your perspective, since we did rag on private equity so much last time. Like, is Japan the perfect destination for private equity right now? I understand a lot of the guys are, reopening offices over there, because it would seem you could take a lot of these businesses out and lever them up and, run the typical playbook, and that it would work quite well.
Yeah. So the private equity playbook would work perfectly in Japan, right? Because you can borrow for free. These companies have massive assets, unproductive assets. They're generally much lower margin than they should be. They're paying out much lower payout ratios than they should be. So yes, if you could get transactions done in Japan, it's a wonderful market for private equity. And if you look at the track records, generally, people that have been able to do private equity in Japan, the deals they're able to do have been successes. The only problem is it's really hard to get deals done in Japan, because the Japanese do not want to sell to U.S. private equity firms. And they don't want to sell at all. They want to stay public. They don't really want any change. They don't like this sort of aggressive type of behavior that you see from U.S. firms. They don't want to be bought and then sold 3 to 5 years later. So there's a huge amount of institutional resistance. That said, M&A is picking up. But I think when you talk to Japanese CEOs, I mean, first of all, it's just a strikingly different culture, which is fun for me. It's wildly successful and yet totally different values and approach. I think my observation would be that, if you ask for a justification for this sort of thing, it's not like there's a logical, rational argument based on like corporate finance rules that they give you as to why they should have 20 years of net income. It's more like, this is what we've always done. We've always done it this way, and it's good and it's safe. And, would you ever change it? We'd consider it. We will debate it. I think it's just a very slow moving, consensus driven culture. It's not a move fast and break things culture. And I think in that sense, this corporate governance reform is a slow moving thing, but it's also a consensus driven culture. And once the consensus is that corporate governance reform has to happen, it will happen. It's just going to happen slowly and deliberately and without any rapid change. And I think that's what you're starting to see. But you don't see a lot of resistance to corporate governance reform. It's not like I think maybe 1 or 2 CEOs I've ever met with have had any sort of negative reaction. They all say, of course, we'd love to comply. We're working on compliance. We're working to achieve those targets. It's not a lot of cowboys out there who say, I don't care what the regulators think. Screw it. It's like a slow moving, oil tanker that's changing course, or battleship, and it's happening.
The cultural differences in markets are fascinating. Going back to what DA is talking about, and this is a little more philosophical and thinking about the world. There was a Munger quote recently that I had not seen that I loved, where he's like, micro is what we do, macro is what we put up with. And for the longest period, for the listeners that are older, they'll remember the Japanese widowmaker trade. And now you're seeing Japanese bonds finally start to pick up. But as you look across markets, the chart that stands out almost more than anything in the world to me is this ascent. And we're writing a kind of a book, coffee table book on this topic, but it's this ascent of the U.S. as a percentage of world market cap, where in our lifetime, back then it was 30%. This is from JP Morgan Guide to the Markets, which is a pretty great publication. And you just have this monster move where it's now 2/3 and the rest of the world has declined. And I was like, imagine going back to someone in the 80s when Japan was taking over the world and saying, guess what? You're not going to be the largest stock market in the world. Not only are you not going to be the largest, you're going to go from 40-something% to 5%. And then, the US is going to go from 30 to 60. Like, imagine the possibility of that. And I think most people would have said, you're crazy. And so it's just kind of fun to think about this going forward, and alluding to DA's topic about the profit margins in the US, as we brainstorm kind of coffee happy hour topic and say, well, what would cause this to change? How would things be different? Every manager on the planet, particularly the value folks, expect profit margins to mean revert, right? And they just keep going up. But the one thing, and I don't think we have this chart, so I'll add it later. I saw it recently from Visual Capitalist, and they had a graphic on U.S. Global equity participation rate. meaning what percentage of people own stocks and how much of it is it, and it includes pensions. And the US was, over half. But most countries in the world were like 10, 5. And I talked to my friends in Europe, and it's not a culture of equity ownership. It's a culture of maybe real estate, cash, big cash owners. Talk to people in Japan, a lot of people, young people in Japan, buy and hold is not a thing. And so the thing that I noodle on, when you think of compounding and you start to move out 10, 20, 50 years, like the wedge widens, and the one question would be in my mind is if we can get the US investors off the home country bias and invest globally. So you're not just going up and up and up with just one market, but that wedge only increases. And so if you have the rest of the countries in the world where the citizens and the governments and everything else are not investors, it's an interesting idea. Is like, why would that gap close? Right? Because the math of an 8% return versus a 4% return or a 0% return, unless you have markets like a Great Depression where they go down 80%, it seems like it's something that only increases. Anyway, thoughts?
No, I think it's a great question. And, that gap could close in two ways, right? It could close with US investors holding more international equities, but it'll also close with international investors owning more international equities. And you think about the Chinese culturally shifting from a real estate oriented saver mindset to a public equity mindset, or you think about India, and how much wealth is being created in India. That's going to go into the markets, and it's going to go into their markets probably disproportionately because they'll have a home bias too. It's just,
if it doesn't just go into gold and silver, which something seems to be going into gold and silver.
Might be all of the above. Again, I come back to this question of what's driven the expansion of the global balance sheet, how much of that is multiples versus fundamentals, and which things can continue versus which things were sort of one time. And, in the US, there's a great Fed paper, forgive me, I forget the author's name, like 2 years ago. He basically said all the excess returns of the US stocks can be explained by low interest rates and a reduction in the corporate tax rate. It was like a, accounting identity kind of argument. Like if you just add up all the savings for corporate America that just mechanically occurred as a result of these two factors, that explains a lot of the earnings growth. So, you go, is that repeatable or not? Well, I don't know. The corporate tax rate is not zero yet. Are corporations more or less influential in government than they used to be? Probably more influential. So would you bet that rate's going to go up or go down? I don't know. It's battling against a kind of populist uproar over inequality. But I think what's interesting right now, particularly here, is this deficits issue that Chris Brightman has highlighted really reflects is that there is a shared interest now in deficits between the poorest Americans who are addicted to entitlements and need entitlements, depend on entitlements, and the richest Americans who are addicted to equity valuations always going up. And both of them achieve their goal by deficits increasing. And then the third player in this equation are politicians who never really have much of an incentive to cut deficits. So if I had to bet, I would bet they keep going up. And that's probably going to be a good thing for equities. And you may see similar kind of behavior in these other economies where, by the way, the debt to GDP ratios are not particularly better than ours. They're worse in a lot of cases. So I don't know. I think this could be a long-term global phenomenon. It could have decades more.
As we wind down, 2026, you guys, what else is on your brain? You had some great book recommendations. I haven't read either of y'all's. Dan was The Ocean and the Stars. DA actually recommended a book that was former podcast alum. We got to get Mark back on the show. He was one of my more thoughtful favorite chats, although I'm going to give DA a little crap because I just want to point out, this is what the average page looks like, listeners. If you can see this, there's at least 17 equations per page. So I may have to audit DA reading through this full.
Dan may be the only investor in the world who actually uses the Mahalanobis distance.
I think so.
Which is what that book is basically about.
That's awesome. I just picked this book up. I took one look at it and I was like, yeah, no, sorry. I'm donating to Mark and his team, but this thing is not going to get read anytime soon. But it looks interesting. We'll get Mark on the show to explain it. You guys are big readers. Anything that has been interesting, books, white papers, thoughts?
There's this Italian guy who's he was like the deputy to the prime minister or something, or foreign minister in Italy. And then he decided to write these two books, one of which is a fictional biography of Putin. So it's like his take on what Putin's life must be like. And I think he's actually interacted with Putin through the Italian state government. And then his most recent one is called The Hour of the Predator. And it's on how our global world is being taken over by predators. I mean, he's a lefty, so he sees this as a bad thing. You know, he's not like an evolutionary biologist who's like, finally the predators are getting what they deserve, right? He's a little bit skeptical of it, but his analysis of the sort of predator concept, I thought was quite interesting and a fun take. So
to be specific, this is like alpha predator in the jungle, not like Epstein predator. That word, I feel like has a very distinct meaning today.
Right, exactly. Right. He's saying, Putin is a predator and Trump is a predator and Elon is a predator. Right. He's sort of saying these, predator is the most pejorative word, but these sort of world bestriding, aggressive people that are willing to kind of force the world to do what they want. And he's both writing about how the rise of these figures, and then he's writing about sort of how they're sort of pushing against nothing, that there's no there to stand up to these people. And again, it's from a sort of lefty perspective, but it's an interesting concept, and he's a great writer. So The Hour of the Predator, I do recommend.
DA, you got anything?
Well, yeah, I mean, Dan's holding down the liberal arts here. You know, I just started, this is like a pretty imposing book. I just started the old book, Active Portfolio Management by Kahn and Grunwald. And, I've been really trying to understand the pod shops. And this book, is one of the foundational texts that I think powered a lot of the thinking in that industry. It's got me just entertaining this possibility that the pod shops prove the limit for stock picking alpha.
And what do you mean by that?
Well, these firms have more money than anyone in history, basically. They can hire anyone. They can hire the best stock pickers in the world. If you're someone who's talented at that, it makes a lot more sense to go work for one of these places than it does to start your own thing by dint of their comp structures. And what they do is they build these portfolios that in principle have no systematic exposures, that are, quote, pure alpha. No beta, all the factors hedged out, and not just the canonical factors, all kinds of statistical factors that are, identified on a daily basis that are meant to hopefully reflect even market microstructure stuff that's very transient. And what their managers can do under those conditions is maybe generate 1.5% to 3% returns. So if they're doing that with long short portfolios, it kind of makes sense that if you were long only, the most you could hope to do is half of that, probably less. There's probably some good reason why you could only do less than that. So I just increasingly think like 50 to 150 basis points may now be sort of theoretically proven or practically proven by the pod shops to be the most alpha that you actually can generate from stock picking. And everything else is just some kind of beta. If that's true, I mean, people already like the folks on this call already know the active, mutual fund business kind of stupid and has been for a long time. But like that just tells you the best that they could ever do. Minus, and then they charge on top of that, right? So it's less than that. It's like anyone who's telling you that they're generating more than 50 to 100 basis points of alpha through their security selection is probably not correct.
Now, let me just pause here because what many people are going to hear is, what I've always known, you can't generate any alpha in public markets. But if you go to private markets, that's where the alpha is. So I would just say DA's insight should be a universal one.
Well, the private markets, Dan, you wrote about it. It's not where all the alpha is, it's where all the vol is. Wasn't that your paper within us?
You think about the sophistication of what these guys are doing, right? Like try to read active portfolio management if you have it, and then think these firms have totally internalized and implemented this, and that's what they're able to produce in terms of alpha. And then you go read like the websites of private equity firms, and they're like, we value long-term partnerships and our differentiated platform for long-term growth. And you're like, which of these is more sophisticated, or like which of these is the predator and which of these is just like a sort of like fluffy content marketing machine that's,
Yeah, it's like which industry is more likely to blow up? I ask that sincerely. You got a lot of leverage in both. You have more leverage in the pod world, and it's the smartest guys in the room type of thing. So there's certainly risk there. I'm just fascinated by how much leverage in the overall markets do they represent? Where are we collectively as investors doing something stupid right now? And these are all candidates.
Listeners, if you're a Pod Shop employee, you can give DA a call and give him all your secrets. He'll give him some insight. He won't.
Please, I want to talk to you.
He won't publish it. But it's funny, a lot of our world on both sides, but particularly in the side that is a little more long only, the statistical runs are often career long, where you can't come up with any signal based on, Ken French, we were talking about this, is like anything under a decade's like it's noise, but people's careers are a decade. 2009 to today has been one regime, which is US up, beating everything else. And like that's an entire career of 15 years. And so I think part of it is just the narrative. I've been thinking a lot about storytelling. I was listening to a great podcast with Ted Seides and a Eider storyteller named, I think, Matthew Dix. And he's written a couple, the podcast is great, but he's obviously a good storyteller. He's written a few books, story-worthy, I think. Anyway, that would be my suggestion. But to think in terms of stories and how much of the marketing side on some of these is just that narrative, right? And then say, well, got 10 years, come back in 10 years and find out if it was any good or not. We'll see. I don't know.
The good news, right, for anyone listening or any of us who have ever failed at investing is that that was just bad luck. You aren't stupid.
I'll take it. Gentlemen, this has been a blast as always. We'll do this hopefully every 6 months. We
I love it.
We'll pick an asset that's hated and maligned and then watch it go up 50% and celebrate. That seems to be like a good formula. Thanks so much for joining us today.
Thank you.
Thanks, guys.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.